All right, I think we are live. There we go. We're taking a look here, September 10th, Tuesday, S&P 500 trying to recover from a basic growth scare. We're looking at a growth scare here, which is, hey, economic growth is going to be lower in the next 3 to 4 months. Well, the S&P is going to price that in. That would mean earnings come down. Oh, let me get that started. There we go. Now we're live. Right? So we're going to take a look at some growth trades here. We do have some growth, some recession trades. Let me make sure this thing is stable. There we go. We got some recession trades we're looking at just in case something slips. Um, going back to the price action, you had the S&P 2 days ago drop pretty dramatically. And until we get above that resistance, we're looking at 551. Right? In the short term, it's like 548, but we're looking at 551 for SPY. Until we get above 551, the S&P is trading as if we're heading into a recession, right? All the employment numbers are coming down, ISM services, payrolls, a lot of them got revised lower, so we are looking at a growth scare at the moment. And I would say rate cuts are going to help for sure. Rate cuts are going to relieve some pressure. There are some names, there are some sectors in the market that can benefit from rate cuts. But at the moment, it's pretty confusing. There's one trade, though, that I believe is going to be, over the next at least 2 months. When the Fed cuts once or twice over the next 2 months, I think we can see this asset class really start to move. All right, so we're going to get started here. We got S&P 500 basically trying to recover from the sell-off that happened on Friday. The weakness in jobs growth, the weakness in employment is continuing. And it's not very bad, but it's backwards looking. All the data is always backwards looking. We're looking a month back. Therefore, today it's a lot weaker than, probably what we're seeing. The S&P is trying to price that in. Okay, we got another macro force that's telling us the recession is imminent. Okay, we're going to move over to the bigger time frame here. We're going to go to oil. I want you to check out oil, crude oil, wherever you're looking at. Crude oil is starting to dump. Okay, we've been watching this for the last 6 months, waiting for this to happen. We said if it breaks out, not good. Now it's breaking down. Okay, now the breakdown is positive for markets, just not at the moment. This is positive. Inflation has broken. Inflation has broken. Inflation is not coming back. Now the Fed needs to cut. Now the market knows, hey, the Fed just needs to cut rates. That's going to get things accelerating again. And the market's nervous, nervous that the Fed won't cut in time or the Fed won't cut enough. So that's what we're looking at here. Oil breaking down is pointing to recession. So who's actually going higher? There's only 2 asset classes here that I see are actually starting to move. Two or three. Okay, that number one asset class is going to be long-term bonds at the moment. Okay, the market is pricing in recession. We have the S&P 500 double topping, right? Starting to roll over. Probably comes down here a little bit. Who knows how far it goes? We don't know. But we are trading sideways, right? Short-term pain, long-term gain. So we're going to be looking for, after the Fed cuts rates, some more constructiveness for the S&P. But for now, the trade is TLT. Been saying this for a while. Okay, we've been talking about this. If you're on the Twitter, you see it. I'm tweeting about it. This is the only asset class. If we go back on the monthly, and I'm a crypto guy. Look, I'm long crypto, very long crypto. But in the intermediate, in the next 2 months, I think bonds are going to outperform everything because we're heading into the period where the macro really starts to move, and where growth doesn't precipitously fall. It falls quickly if it happens. That's the growth scare that you might hear about on the news. And guess what? Guess who performs when growth collapses? Bonds. US bonds perform when growth collapses. That is typically what we see. What up, Dimaj? I see you. All right. So we're looking at the bond market. The technicals are absolutely beautiful. I mean, look at the RSI just holding higher, right? We had that bullish divergence happen October 2022 all the way through 23. So for a year, we saw bonds have more inflows, more buying pressure while the price was falling. And now we're actually getting bonds start to break out. They don't break out a whole lot. They break out 2 to 3 months, they slow down. And then they break out again if things continue to weaken, if inflation comes down. And we are seeing inflation come down a lot. Inflation is collapsing. Bonds can now breathe. Now the rate of interest for the bond, right? What's happening here is once the inflation rate gets below the yield on the bond, now you're yielding more than inflation costs. If inflation is 3%, right, it's going to remove 3% of your money, which is basically your purchasing power. Bonds are going to add that extra. And what are bonds trading at? This is 101, but they have a yield to it, right? You go to the 10-year yield, and that yield is falling at the moment. So a lot of people are still, piling in here, but that yield is at 3.64. So the yield is higher on the bonds than inflation is, right? And guess what goes up? TLT, because the government guarantees to pay the loan. They guarantee to pay the interest on this, so investors pile into bonds, and that's what we're starting to see here. Technicals, like I said, are beautiful. We're starting to get this breakout right here, this reverse cup and handle. We've been looking at it for a while. Okay, there you got one head. I'm sorry, you got the shoulder, right? You got the shoulder, you got the head, you got the second shoulder. We've broken out of that. We're starting to lift off as the growth numbers continue to weaken. Bonds will continue to bid higher. Now, I got a minimum price target. This is not financial advice. It's just what I'm looking at. I think we're headed for, I'm looking at the Fibonacci here, somewhere around the blue Fibonacci. Okay, right after the golden pocket. So I think we're going to go at least to 109, right? The previous resistance. If things continue to accelerate, this doesn't mean bonds are guaranteed to go higher. It's just the probability for the bond trade, for the recession trade, right, to continue to lift is increasing. That probability increases while we see the VIX rise because of a growth scare, while we see the employment numbers weaken, while we see the ISM, industrial production, retail sales weaken, the probability for bonds continue to increase. Okay. And so you have what? You have growth stocks, you have value stocks, and you have defensive stocks. And the other trade, other than bonds, and let's look at the daily, let's look at the weekly. That was the monthly chart. Okay, you see the RSI is just lifting. We're going to get oversold at some point. That's when you take off the trade. Once you get, I'm sorry, overbought. Once you become overbought, okay, the trade has pretty much ran its course unless there's a black swan event. But I think is definitely you got to keep your eye there. We're looking at 109. Okay, these are bonds. Now the other trade is going to be, and this is all because oil. Look at oil. Just take a look at oil. Oil is dumping. Okay, oil's starting to dump. The war's never really picked up. Inflation's coming down, but this also means energy demand in real time, right? Using supply and demand. If prices are falling, that means either supply is increasing faster than demand. Well, it always means that, but it means you're either getting an impulse in supply or you're getting demand fall. My guess is there's nobody pumping out more oil. My guess is there's actually, OPEC is trying to pull back on oil, and you have, the US economy, the global economy in China starting to slow down. So I think oil demand is definitely coming down, and that's really the big signal here for TLT to break out. Okay, so I'm waiting for that. Next is going to be, we have XLU, utility stocks. Okay, I'm going to switch over to utilities. Now we're going to look at some utility stocks. It's going to be XLU. And utilities are part of the defense. So utilities usually perform, they have dividends. They usually perform better when there is, recession or really low growth. Not inflation, but we don't have inflation, right? Inflation's pretty much disappearing. It's headed lower. So we're looking at utility stocks. I'm going to go XLU for the index, the S&P 500 index. You can see it's been in a bullish trend. And heading into recession, these usually do pretty well. Individually, we'll go through some of the individual stocks. Some of them are overbought, oversold. We go to CEG. This is one I like the most. They're benefiting from data centers, right? Big tech. So when you think of CEG, you got to think of fueling AI, right? Energy demand for AI is, very high, and it's going to continue to increase. The grid, they say the grid can't even handle it. And I see a bullish flag pattern forming. Yes, it looks kind of nasty. It's not the most beautiful pattern, but if you're looking at things speeding up over the second half, which I think they still do, or weakness, guess what? Data centers still do well. Meta's not going to slow down their data center spend. Amazon's not slowing down. Even if we hit a recession, the mega caps don't care, right? The hyperscalers, Microsoft, you think they're going to slow down? They're not going to slow down. They're going to continue spending for AI. Therefore, data centers, anything that's going to be utility sector is going to do well. Okay, next you have Exelon Corporation. I really don't give a damn about these. These are I'm just throwing some tickers out there. Okay, I'm just throwing some tickers out there. This one looks okay. Not too sure about it. Duke Energy obviously has been going higher for a while, breaking out to all-time highs. Now, once it breaks out, it can probably has some more room to the upside. I don't like it as much. We also have American Electric Power Company, and some of these might be more. You got to do the fundamental analysis. Some of these might do better without data center. I'd be focused on the data center utilities. Those are the ones I think do the best, and I'm going to keep my eye on that. Let's see what do we got here. Make sure that we didn't miss anything. JP Morgan. Oh, JPM. TAD on base. Not sure what you meant there. Poker vibes. Let's see. What do you think about CPI coming up tomorrow? Okay, I just saw that. Yeah, we're gonna hit CPI. I have that on the stream. We're gonna look at CPI. Anyways, yeah, look at the utilities. All you got to do is go to XLU, or you can look up holdings for XLU or just utility stocks in general. Is there any individual stocks that do well? There's probably only a handful. This one's trying to recover. The index is going to do well. Wow, a lot of momentum here. Who is this? Southern Company. Okay, Southern Company has a lot more momentum. Right. I mean, that's a pretty strong trend. We do if we try to look at the trend here. Some of these, I like CEG though. I'm going to stick with CEG, and I'm selling puts on that. I'm not really going long options. I don't trust it at this moment. We're not confirmed yet, but these have a pretty strong uptrend. Okay. This one might be a okay buy. It's selling off. So those are just, CEG stocks. Now the other part of this, so we have TLT, we have long bonds, right? Long-term bonds, pricing recession, TLT. We got utility stocks. We also have real estate stocks. Okay. Why? Because real estate's been in a recession, and you're going to increase margins immediately. XLRE. Okay. This is the real estate ETF. It's been in a downtrend for a long time. Starting to turn up here. You can see it's pretty much, there's a lot of momentum here. It's overbought on the weekly for sure, right? But this can continue on the overall index. When the macro changes, then you can really see these continue to lift. JP dropped 8%. Doesn't happen very often. Yeah, JP Morgan, a lot of the financials are not moving up. Real estate seems to be the only cyclical, right? And we talk about cyclical stocks, we're talking materials, basic materials, real estate usually, but real estate's going higher. Financials, industrials, right? Those are interest rate sensitive stocks, but a lot of them are not doing well except for real estate, because I think real estate has been the most underowned. I think it's been the most underowned, right? Out of financial. Let's go to XLF. Watch XLF. And when I look at these indexes, I'm not necessarily saying, oh, you want to own the index. Some people do. For a trade, not really. They're slow, they're crappy unless you're selling options. I would just say more so it gives you a vibe of what sectors are doing well. So XLF's okay. XLI industrials are still moving up, but really XLRE, which is going to be your real estate sector, this one has the most momentum, right? So that's what we're looking at here. CPI should be coming in really good tomorrow. So I can see, going back to SPY, I can really see the S&P not really dropping yet. I don't know. This is hard to predict. This is really hard to predict. If I look at the RSI, okay, what is this, weekly? Yeah, let's go to the daily RSI. I would say that positioning wise, the S&P has one more drop. Maybe it retests the lows here. Okay, we're moving off the bottom VWAP, anchored VWAP. So we either retest these lows or we drop a little further, and that's going to come down to retail sales that we have next week. But for sure, I want to show you guys positioning really quick. Let's go ahead and look at the positioning. I'm going to show it on TikTok. Let's see if we can. zoom in here. There we go. Zoom in a little bit, and then I'm gonna pull it up on YouTube or the stream. Okay, so this is just S&P 500 positioning. Active fund managers. So where are they positioned? Are they over positioned? If you're over positioned right here at the 100% mark, okay, 100 means you're fully positioned. Once you get fully positioned, you're probably looking at a correction at some point. So we're coming down to the 50 mark. 50 mark is down here. Okay, so I think we're gonna need to come down here while the Fed goes into rate cuts. Um, Now rate cuts are bullish, but not necessarily immediately, right? The market is trying to price in the worst case scenario. If the Fed cuts 25 basis points, the market can still sell off because it's screaming, hey, we need more. We need 50 basis points. And then the data comes in. It all depends on the data. It's a lot of data dependence. We'll see how the data does. But either way, I would just guess, hey, I wouldn't get super long. If you're trading day to day, it's different. If you're week to week, but if you're swing trading, I wouldn't get super long until positioning really comes down here for the S&P. We get this every Wednesday, so the next one will come out tomorrow. We'll see where we're at. You can see that it's weakening. Positioning is obviously weakening. We had a correction every time up here. So when you get down, once you get to the 50 mark, that's where usually you see some constructive buying. Markets start to pick up again. Okay. And then looking at that CPI report, let's dive a little bit. Inflation report tomorrow. Now, this is the part that is going to be very positive for markets, which eliminates a lot of the other risks. This really narrows the risks to purely employment and purely growth, which we can do because inflation is at 2.9. That was a great reading. The expectation tomorrow is 2.6 on a year-over-year basis. This includes food and energy, though, right? So including food and energy, inflation is dropping like a rock. It's dropping like a rock. 2.6% is going to take us down to where we were, pre-pandemic? Yeah, March 2021. So we're good. We're good. Inflation is great, right? Inflation is great. Not today's inflation, but the rate going forward is looking good. Obviously, it sucks today. Prices are ridiculous relative to the past 4 years. But going forward, inflation is back to normative levels. We're back to even. So I'm not too worried about that. The core looks a little different, though. Core looks like it's going to be sticky this month. The expectation is sticky. This is a very positive read. I just don't think the market gives a damn about inflation the way it did, earlier when the risks were inflation. Now that the risks are growth, I think we're looking at jobless claims coming out the next day, not even tomorrow. But jobless claims, are they going to tick up or tick down, right? We're looking at jobless claims. We're looking at, I see you in there. We're looking at jobless claims, initial, right? And we'll see. I don't even think they really budge. They might. If they jump, TLT is going to jump. I'm telling you right now, if inflation comes down, TLT up, right? Bonds are bidding up because that takes us closer to the Fed. That's a correlation with slowing growth. Whenever inflation comes down with growth, bonds bid up. Jobless claims jump, bonds explode, right? So either way, bonds just look really good, long bonds at least from my perspective. And then Friday we have Michigan consumer sentiment, blah blah blah. I think it's really CPI and jobless claims, and then retail sales. This is the big one, okay? Because 60% of the economy. Actually, this is a big day. Next Tuesday is a big day before the Fed meeting. Right before the Fed meeting, right? The Feds are probably already going to have this data, but we're going to be looking at retail sales month over month, year over year. Okay, retail sales are the consumer spend side of retail items, and they're still positive, right? They're not falling apart yet. So it's going to be important to see how this comes out. No expectation yet. We have no consensus yet. No consensus on retail sales, 2.7, whatever. But if they are falling, the bond market's going to bid up even higher. And then we have industrial production. This is the production or supply side of the economy. If this falls, right, retail sales is demand. This is supply side, production. How many things are being produced, which is GDP. And if that falls on a year-over-year basis, we already went negative. Okay, industrial production is already turning negative. It's just flat. It's not really moving. It's in recession. Then the Fed needs to cut. The market's going to say, dude, you guys better cut. Even if you cut, we're still going to sell off until we see growth numbers pick up. I think we're looking at the market trade sideways overall. Maybe there's some sectors that do well, but I think we're looking at the market um, kind of sideways to weaker until it sees the growth data actually respond to the rate cuts. Okay, unless they turn on the Fed balance sheet. If they turn on the balance sheet, then the market's going to bid up because the market moves not necessarily off one rate cut. It is constructive, but it's going to move off that damn liquidity, right? So let me remove that. Let's get back to the charts here. It's going to move off liquidity. All right. So Dimaj, is there some stocks that don't follow the good or bad news on the market? Why is that? There is some stocks that don't follow the good or bad news on the market. Well, there's individual stocks who have good earnings, and they're idiosyncratic, or they're not completely tied to the market. So yeah, there's stocks who they do care about the news, the macro data. There's individual stocks who care about it. It's just that they might have already priced in a lot of weakness. And then now that the business is picking up, and the business is picking up, then they're not too worried. Like, it's under owned, it's under positioned usually if it continues. So let me see what I have. I might have one in here, but either way, no, most things are going to be correlated to the market overall, right? These are all home builders. This is all tied to the cyclical names, to the interest rates being cut. No, I mean, honestly, the only company is not really tied to is not really tech in general, but specific tech. So Meta might be one that isn't really that tied to good or bad macro data, because Meta isn't really too reliant on the consumer, or yeah, they're not really too reliant on the consumer. I mean, they're going to be affected, but Meta's not going anywhere. Amazon a little bit. Amazon does data centers. So if you benefit from business spending, right, which is going to be the utility sector at the moment, if you benefit from that, you're probably going to do well. So I would say the most idiosyncratic sector at the moment is probably going to be utilities, right? If good news is good, utilities go up. If bad news is bad, if the news is bad, utilities still go up. Maybe not as much, but they're still going to go up because of the AI narrative. United Kingdom stocks continuously go up regardless of any good or bad news. Yeah, maybe. I mean, give me a ticker for the United Kingdom stocks. Give me a ticker for that. They're probably very low flow. I don't really know how that market works over there in the UK. El Dorado stock. Okay. And my guess is they don't have as much growth. So even if they might be growing at the moment, but I don't know. I'd have to see their charts. I really don't know. Marks and Spencer. All right. So oil is signaling the recession trade, right? Positioning for the S&P is unraveling. We'll do some more technicals on the S&P. TLT, I think, goes higher. XLU goes higher. Real estate is going to be going higher off rates. CPI looks good. Retail sales, we don't know. And then we have the Fed meeting February 18th. So put that on your calendar. Our biggest days are going to be February 17th, after tomorrow. Obviously, tomorrow is CPI. But then we have February 17th retail sales, which might be more important than CPI, because the expectation for CPI is pretty obvious. It's pretty obvious inflation's coming down. The real question is growth cooling still, or is it decelerating at a fast pace? Right? Is it really starting to decelerate? And I think crypto is going to perform into the end of the year. I think it decouples because Bitcoin's been consolidating for 6 months now. 6 months of consolidation. And it looks, I mean, I thought it'd perform earlier, but I think it's gonna come in the second half of the year. It probably, just like everything else, wants rate cuts, right? Crypto's solely driven, not solely, but mostly driven by demand and liquidity, right? Market liquidity, banks, or the central bank creating more reserves for the commercial banks. The commercial banks taking more risk, doing more loans, which is going to be a lot of margin that investors start to borrow when they see Bitcoin rip. So I still think Bitcoin's going to perform, crypto is going to perform in general at the end of the year. I thought it would happen sooner. I was wrong. Um, but I think it's rate cuts. At this point, it seems like the market just wants to see rate cuts. And the chip stocks, I think they're sideways. I think they can have a recovery like Nvidia and AMD can recover, right? I'm still waiting for Nvidia to get down here. I think 107 was a good target. Um, but I think it's a good target. I mean, I'm looking at that RSI. This might have been the bottom for Nvidia. We'll see. Nvidia doesn't care too much about rate cuts. It's irrelevant. The revenue is strong. It's just positioning. It's just de-risking from Nvidia. But I guarantee you, investors are coming right back into Nvidia. Okay. At some point, it just might take some time. We might have to go through October. I think October, you're going to see most stocks mid-October, is my guess, really starts to turn back up. So I like mid-October. I think mid-October, that's where I have a lot of my contracts, my bullish contracts mid-October. Let's see, what do we got here? Thoughts on X still? I know a lot. Oh, okay. What up, Vadim? I don't really like Still at the moment. I know it's kind of sold off, but it's not. Here's the thing: X Still Corporation is mostly tied to. No, you're good, Doifer. Is mostly X Still is mostly tied to commodities, and commodities are more cyclical. They're not individual stocks. So when I see for example, when I see SMCI sell off, it's tied to investors' confidence and positioning and margin. People probably used a lot of leverage, right? So they're leveraging out, they're selling it back off, it's coming into support, but it's an individual stock. So it just needs one piece of news to move higher or bad news. And honestly, a lot of stocks bottom on bad news, right? And I know I'm jumping all over the place, but I'm trying to set an example here. Lululemon actually traded this on accident the other day on the earnings. Okay, the earnings were bad and Lulu jumped on the earnings. Now it did trade lower afterwards, but it actually jumped the next day. And I think because a lot of times, I mean, this is just, markets are about art and thinking two steps ahead. A lot of times, this price action is already pricing in the worst of the stock. And then when the earnings come out, it's like, okay, the worst is over. So now they start buying the stock because of the guidance. So individual stocks move much different, where X still is very tied to commodities. This is tied to global demand. SMCI tied to chip demand, right? Tied to confidence way into the future. I mean, these are risk assets. SMCI is a risk asset. It's a AI. It's a play on AI, one of the infrastructures for AI. And so the earnings and the potential is 10 years out, right? Where still is a commodity. This is all about commodity supply and demand. And this gets priced in a lot sooner. These are not risk assets per se. US Steel, if demand is bad, demand is bad. So you need really China to come back on. You need Europe to come back on. You need the US cycle to turn back up. The question is it oversold? Is it time to buy? Maybe, I don't know, but I just don't think you're going to get much of a thrust or a momentum thrust the way you would do with chips or crypto. So if you look at Still over the day, if you just look at the long-term trend of Still, right? Let's look at the weekly. This is what I mean, Vadim. It doesn't really move much, right? It's a cycle. It moves up when the economy, when the economic cycle increases, then it moves back down when things slow down, then it increases. So we might be going lower for Still in this long-term range. This is, again, it's not a innovative company. It's not inventing anything new. If you get a boom in the economy, in the global economy, then yes, you could see this move higher. But for now, the way I look at it is it's just going to be moving in this range. And it's at the top of the range. It's at the top of the range. You need rate cuts to really get basic materials moving. Well, it's really going to start with industrial production, start producing more things, and then financing increases. You need more materials, you need more steel, you need to build more infrastructure. Real estate starts to increase. So yeah, US Steel might do good. I'll just wait for the rate cuts. Maybe one cut, see where this price action goes. It is oversold on the weekly, so it could be a good options play, but I just don't like these because they're not, the risk reward kind of sucks to me. They don't move much, right? It doesn't move much. So even if it does move up, man, that actually is a big move. Hold on, maybe I'm not looking at this right. 100. Okay, never mind. US still does move a lot. Okay, I'm wrong. Those are some big sell-offs. I'm just a little skeptical of the range, to be honest. I'm just skeptical of the range. Um, and also it relies a lot on global demand. So we'll see. I mean, it's in the trend. It's in the trend. It looks oversold. Maybe it moves with copper. Copper kind of looks similar. Um, I would have to look at the earnings report also on why it sold off so bad. So I don't know. I don't want to give too much. I like copper better. But it could be a buy. I mean, it is oversold. You could see if it holds this level for a while, have your stop ready because it looks like it can move a lot. I just don't like have I don't have an edge here on these commodities. So I would wait for it to bottom a little more. I would wait for rate cuts because this thing can really look right now. Here's the thing, Vadim. Right now, with oil dropping, oil is signaling a global slowdown in energy. That means infrastructure demand is coming down. If demand for steel comes down, prices collapse while the supply is increasing. So commodities are dangerous. You got to wait for that trend to show support. I wouldn't really get too long US steel at the moment. That's just what I would say, especially how fast they can drop. Um, Celsius, a lot of these are getting crushed, man. These are going to look good though. So I'll say this: I wouldn't trade Celsius at the moment because it's so oversold. I mean, I want to. If you're able to trade options like sell puts, you could sell puts on Celsius a lot lower, right down here to like 26. You could probably get some good premium, and then you trade it about 45 days out. So you're looking mid October, maybe even November, and you're basically saying by October, a couple months, 45 days out, it'll be higher than 26. It's an easy trade unless there's something very systemic, but it sounds to me a lot of stocks are starting to price in a recession. So I'd rather just go long TLT and wait for that move to really happen before is this no wonder. Let's get on the log chart. There we go. Yeah, I'd rather go TLT, just wait for that to play out and then see these oversold stocks, right? Unless you're just collecting them, you just never know how low they can go. CMG is recovering. Elf, okay, yeah, Elf is the other one getting destroyed. So yeah, I'm keeping my eye on these though. I'm keeping my eye on Celsius and Elf. Are they consumer staples? Maybe. I think they're kind of risky consumer staples. They're not necessarily consumer staples. Consumer staples would be more Clorox. Um, you're looking at Clorox, you're looking at toothbrushes, toothpaste, stuff that people need every day. Do they need Celsius every day? Well, yeah, some people, but it's not a necessity. Makeup, is it a necessity? Maybe, maybe. So yeah, I would keep my eye on it. I would definitely keep my eye on it. I want to see how the market reacts to those rate cuts. They are extremely oversold though, so it wouldn't be out of the question to take a position when they're this far. I don't think we're heading into a deep recession. If so, if we slow down. Rolls-Royce did not follow the market at all. Rolls-Royce over there in maybe they're looking at European demand. I don't know. I don't know. I don't even know what I don't thing is I don't know what Rolls-Royce's ticker is, so I couldn't really tell too much about it. All right. So S&P is coming back to that level. I'll keep my eye on TLT. I really want to keep my eye on TLT. Look at oil just collapsing. Oil is getting smoked. Um, and this is the theme of the stream today, right? I mean, you can see look at all these sell patterns. Sell, sell, sell. They're just selling the trash out of oil because the anticipation of oil demand falling. Summertime is over. We talked about this. Summer's over. Demand is coming down, right? Supply is still up there. And that means inflation is going to collapse, but it also means in the short term, you have the risk of a growth scare. And oil is not is not as big of part of GDP as it was. So I think this is a long-term bullish signal. Okay, oil coming down is very bullish in the long term in the next 6 months, But in the next 2 months, it's telling us a lot of weakness. We need the damn rate cuts at the end of the day. You need at least 50 basis points of cuts, in my view, right? And TLT is pricing. Look at TLT is still making new highs. At least 50 basis points of cuts before the market. And let me add on to that, and some type of reacceleration in the ISMs. You're going to see the ISMs reaccelerate because those are diffusion indexes, meaning supply chain managers are telling you how positive the outlook is going forward. And if you get 2 rate cuts, that's going to relieve the pressure on those supply chains. And if it does, then you should see the ISM move up. And then markets should recover with the ISM. But right now, and here's what I mean by the ISM. We're going to look at this one. We'll go ISM PMI. Okay, I think this is the service economy. You can see it's kind of choppy, right? So services are, and at this level right here, we're looking at 50. So below this level, and I'm just going to mark it, is recession territory. Above it is a growth or expansion, right? It doesn't really mean recession. It just means, why isn't that working? Here we go. It's right here. Right. So above this line is the services sector of the economy. Not really sector. It's really the services part of the economy is still expanding. They're still adding jobs. They're still expanding production, XYZ. So this is what's holding, this is what the economy is holding on to. But as soon as you slip down there, we did a couple times, and we don't get that reading until next month. But if it slips down, the stock market would really tank. But services are becoming bigger and bigger part of the economy. They don't really signal the cyclical nature of the economy the way the manufacturing does, but they do tell you, hey, we're holding on here, right? It's sort of like a lagging indicator for growth. Manufacturing leads, and then services tell you, is it really bad? Is it really good? And right now, services are telling you that, the economy is still holding on. It's not a recession yet. It's definitely not a recession yet. So that's the ISM for services. Now, here's the manufacturing portion. Okay, this has been in contraction for a while. Oh, no, that's not it. Right here. Here we go. So it tried to recover, and we got kind of bullish on crypto, and then it just collapsed. So this is the real cycle of the economy, the momentum, right? The hard goods. I know people say, well, most of the economy is services, but the truth is services come in and out, right? You can go get your haircut and that's it. But the manufacturing, when you go buy a house, you make bigger purchases. Most of the money comes from not services, but most of the economic momentum comes from goods, hard goods, cars, houses, computers. What else is going to be? Washers, dryers, right? So big purchase items are what this is looking at. This is the real momentum of the economy, and it's just not picking up. And also, that's not just consumers. We're talking about big businesses, right? Infrastructure builds, creating more steel, more copper to build a building, to get labor, to get construction, to get a machine. So right now, we're still in a recession, and I think it just needs rate cuts. I think it needs rate cuts. So this is what I'm saying. When this picks up, everything is going to boom. But at the moment, not everything, but mostly risk assets, right? Technology and growth. But right now, no, I don't think so. And cyclicals, but right now it's just it's kind of dampened. Nothing's really going on there. Industrial production is the production part of the economy, right? It's not necessarily where you purchase things, but how many things are being purchased, or I'm sorry, being created. This is important. It is just, there's nothing going on. Let me make it a little thicker here, or a little more visible. There we go. Nothing's going on. So it needs rate cuts, right? If we're going to produce more things, we need rate cuts. This is true GDP. And if it keeps collapsing, you're headed further into recession. You don't want that. You don't want deflation. Okay. You definitely want that. I think this is new orders. Those are tanky, not good. This is oh yeah, that's the ISM again. And then employment, the employment picture in purple is basically the unemployment rate. That's what the market's worried about, but we won't get that reading. Oops. We won't get that reading until next month. So we're looking at jobless claims. So this is all really TLTs going higher, I think. I think we're really pricing in TLT continue to go up. Not TLT, but longer dated bonds. So unemployment is climbing. I don't think it really shoots up to super recession levels. I don't think though. There's too many migrants, right, for work. They're gonna work. They're gonna work if they can, and there's too many jobs that could be filled still in the economy. Is it a very productive, efficient economy? No, hell no. Hasn't been for a while. But it's, we're not at the point where companies are completely collapsing. That's commercial real estate, but technology, cyclicals, those are still picking up. Go to the mall. Things might be slowing, but they're not collapsing yet. So I think we just have a growth scare and then we come back. Now, jobs, these are ISM jobs. Okay. So ISM looks forward and you can see these are hiring. So hiring went negative, and this is the middle right here. Hiring went negative below this line that I'm showing, and then it came back up. But it looks like it's headed lower. So as long as hiring and employment comes down, TLT goes higher. Okay. TLT goes higher. And that's for services. Now, manufacturing, it's already in recession. Employment is already falling. This is what the market is most concerned with, that the employment continues to fall. Non-farm payrolls, this is what everybody looks at. And we know most of them are kind of revised. So payrolls are just falling. Look at, they've been falling for 3 years now. And our negative print would be down here. So we're not negative on payrolls. But most of these payrolls are basically, call them legal, illegal immigrants, whatever. They're non-US citizens. Okay. Non-US citizens are most of these payrolls. So it is keeping the economy better than it was. But what does that tell you about the real economy? It tells you that it's actually weakening. So if construction or real estate or commercial falls, any kind of, dispersion in commercial real estate where a lot of these workers are at, construction, or you get a shutdown for hotels, right? Wherever they're working at, because they're not high skilled workers we're talking about. These are lower skilled workers. This payrolls is going negative. So that's why I'm keeping my eye on out there, right? So I think the market is pricing in a recession. I think that's what we're looking for. The banks are now pricing that in. Financials are looking very weak. Oil is looking very weak. I think it's going to be October before we really see anything constructive happen. Okay. Crypto's, kind of weirdly enough, crypto's kind of pricing in rate cuts for next week. Okay. It's kind of pricing in rate cuts. That's more liquidity. That's more global liquidity. China's going to have to be printing a lot. So Bitcoin's moving higher. Aave is moving right now. I mean, you would never guess that one of these protocols, this is a lending protocol, would be up 100% from what? Where was the low at? This was in July. So midsummer, this thing's up 100%. Okay, Aave, this is a lending protocol because you're cutting rates. You're going to increase liquidity in the system. And this crypto is moving higher. This is one of the only ones that I don't want to say advocate, but I'm interested in. Most cryptos I'm not. There's always a new crypto every day. Most of them, people have no clue. They're getting scammed. They can't measure the business. They don't know the operations. Aave is, Mark Cuban's invested in Aave. Aave is pretty legit. It could always collapse just like every single company could, but Aave is pretty legit. So I like Aave. Of course, I like Chainlink better, but I'm just showing that Aave is moving up. Is Solana moving up? Not as much. Bitcoin is moving up. Chainlink's trying to make a run. Ethereum looks like trash, man. Ethereum looks bad. I don't know why. We need Bitcoin to move up, but check this out. Bitcoin dominance is kind of signaling an altcoin rally. Okay. It's starting to peak here, Bitcoin dominance. So once Bitcoin makes a move, if it makes a move and Bitcoin dominance is coming down, that tells us that there's a rotation. Even though Bitcoin's going up, there's a rotation in altcoins. So we're going to be watching this to see if it breaks out or breaks down. Breaks out, well, it's just Bitcoin that goes up. It could be a sell-off. If it breaks down, we're probably going higher. You can measure the success and revenue of Jupiter Exchange on Solana. Okay. All right, that's great. I'm not familiar with Jupiter. What is this? JUPUSD? That's good. That's good though. So that's good if you can measure the revenue. That's really good. Um, and a good for a lot of other protocols, they might show some type of revenue, but where's it coming from, right? A lot of Solanas is meme coins. It's not real infrastructure, Doifer, you know what I'm saying? A lot of it is not real infrastructure being implemented or adopted by the real economy or the real financial market. It's a bunch of meme coin trading. Meme coin trading is seasonal and it's not sustainable. And I don't even know what Juniper is doing, to be honest with you. So I'm not really talking about Juniper, but it's just like a casino, right? It's not really productive. It's really not productive at all, but it could make you money 100%. And that's what I'm worried about with a lot of crypto people is they get caught up in all these coins. They don't know why they make money, what they do to make money, or why they're even going up in value. So you just got to be careful there. But yeah, hopefully, hey, if you're in Juniper Network, I hope it goes up. I hope it rips. I think all crypto's ripping pretty soon, except for XRP. XRP's trash. Unfortunately, too big and no more narrative. The narrative is gone, right? Chainlink continues to have, I think, the best news by far. And eventually this news is going to price in. It is going to price in. We'll see it price in my view. I mean, of course I'm biased, I know, but I just, when you're working with Swift, when you're working with the real financial institutions, it's hard to bet against that. It's really hard to bet against that. And the last stock that I really told you guys was going to go to the moon was Palantir. Way back here, we talked about Palantir last year. I said this is the number one AI play. Now it's starting to get realized. I think it's overvalued at the moment. Not for the future, but in the intermediate, I think it's a little overdone. Okay. I want to see this RSI reset, but Palantir is another great one. If it ever comes down back to 26 or 25, if we get Palantir down here, that would be a good long-term hold. This is a real thesis here. Okay. And I wrote about Palantir in 2021. I was buying it way back there. Even though I don't own it right now. So it's not just, oh, I'm following Palantir. We've been talking. I did an interview with the Mitt on YouTube I think a year and a half ago about Palantir when it was down at like $8, $9. And now it is booming. And it's supposed to be the purest AI play. Remember, we sold puts here. I still have that there. We sold puts on it. Said, hey, okay, it's time to move. This thing is showing some support. I wish I got a little more long on it, but that's trading for you, right? All right, so we've pretty much been through everything. Keep your eye on TLT. Okay, if this market continues to slip, let me go back to the macro, and you're getting the dollar bid up. So here's a big difference. Okay, when rates come down, rates are starting to fall. These are interest rates for the market. Okay, mortgages, whatever it is, not exact mortgages, like the actual rate here is not mortgages, but mortgage rates follow this index. 10-year yields, right? Pristine collateral, the US Treasury yield is what all interest rates are priced off of. Okay. Long rates, my bad, not short rates. And currently it's coming down to 3.5. Like it first got up to 5. This was very, we're looking at rates we haven't seen since 2008. Okay. And that signals inflation, and then deflation, and then inflation. And now we're not in inflation. Now that we're headed lower, making lower highs, rates are saying, okay, guess what? Inflation is not an issue, and you really have to watch these rates. Now it is growth is a concern. So when the rates fall fast, a bullish narrative would be the dollar goes lower also, because rates are reducing, interest rates are falling. That's more liquidity. That makes financing and borrowing cheaper. And you should see the dollar fall. And I'm going to throw the dollar up here. Okay. Let me add it. DXY. You want to see the dollar fall if you're bullish, because that means, right? That means that the dollar, and let me turn this line a little thicker. You want to see the dollar fall because it means the dollar's being debased. And every country on earth, trust me, they want to see the dollar fall, because the dollar is a representation of the global economy, the cost of borrowing, right? They all borrow dollars. The world's denominated in dollars, right? Their debts are. They're always borrowing. People don't realize this, but the world economy is China, Japan. They're always borrowing in dollars to some degree. So that means, I'm going to turn it white. That means if the dollar goes up, it crushes them. Their debts increase, right? Their debts increase. That hurts their margins. They have to pay more. It weakens their economy. But if the dollar falls, that's good. Now, what I'm worried about here is when the dollar shoots up. So when you have rates falling, it's signaling weakness. Either inflation's coming down or growth is coming down. If the dollar starts to head up, that's a risk off move. So we don't want to see the dollar and rates. And right now we're seeing that they're moving in opposite direction in the past, 3 days? I mean, the trend is definitely like, similar. But if you see the dollar spike, that's a risk off event. People are selling their stocks, their crypto, the global borrowing rates. If the dollar shoots up and yields are falling, that is I don't want to say it's a black swan, but that's a deleveraging event happening globally. They're piling into bonds. Okay. It's not inflation, it's deflation. They're piling into bonds. Therefore, rates are falling. The dollar's shooting up because there's two safe havens when there's a real risk. I don't think we see it. I don't really think we see it. I really don't. But if you see the dollar spike, that is the two biggest risk off assets are US Treasury bonds and the US dollar, because the government always pays you your interest, and the dollar is the safest asset to hold when everything's at risk. So that's a bad signal if this goes up and this goes down, right? Or put another way, you would see, bonds go up and dollar go up at the same time. That's probably an easier way to think about it. So we're hoping the dollar actually comes down over time, right? But in the short term, I think bonds are the trade. You can see it's really starting to pick up steam. We've cleared resistance. We're starting to clear this previous resistance on the bond trade. Also, inflation tomorrow doesn't change anything. If inflation is lower, right, that just means bonds go up. That means bonds go up if inflation is showing constructiveness, and inflation is not going up anytime soon. And then, I mean, it's not. Look at oil. Oil collapsing is telling us inflation expectations are going to be lower. So you can see the cup and handle for TLT, or if you want to look at it another way, it's a reverse head and shoulders, right? Shoulder, shoulder, head. A bunch of patterns here. The RSI, yes, it's a little overheating. It's headed towards overheating, but you got to understand that this asset jumps only a couple times of the year. It jumps when inflation collapses. It jumps when growth is at risk. And we're seeing both of those play out. Growth is at risk and inflation is collapsing at the same time. So I'm looking at 110. It's not the best instrument to trade, but there's a lot of inflows in bonds. More volatile version of TLT is, would you say ZROZ? ZROZ? Let me see. Is this a future? PIMCO 25-year coupon US Treasury Index. I think this is not leveraged, is it? Okay, I see what you're saying. Hey, thank you. I'm going to check that out. ZROZ. Is it on Robinhood? I'll check out the options on it. ZROZ. Let me write that down so I don't forget. I'll check it out. For me, it just depends if there are options. I'm not buying this outright index with shares. I'd be doing debit spreads, call debit spreads, just make it cheap. I don't need it to go to the moon. I just needed to hit a certain level and cash out. Could crypto be the way to save the global debt? Oh, with Trump, the way that Trump's talking about it? Who knows, to be honest with you? I mean, that's what we hope, Dimaj. But who actually knows if Bitcoin is the way to save global debt? I don't think the fiat system in general, nobody cares about the global debt. It's irrelevant. It's just about the interest payments. As long as you can get the interest payments, are good. It's a credit card. The global economic system is a credit card that when the interest gets too big, you just take out another credit card and you pay off the interest. And then when that interest gets too big, you take out another credit card and you pay off the interest. Therefore, you're saying, well, what about all the debt that's accumulating? Well, all that debt that's accumulating is the global real estate sector, is the global stock market, is the global bond market. In general, not in general, but if you really think about it, okay, and I know this is kind of what? The stock market, the asset prices are a reflection of inflation. They're a reflection of moving your money into assets instead of using cash, because cash is being debased, which is the debt growing, right? So as stock market, treasury market, real estate market, that is the debt that's also going up. It's just in asset form. Instead of debt form, it's in asset form. So no, I don't think Bitcoin solves the global debt. I think it makes things more efficient where you get less debt per GDP. You don't want no debt. You just want less debt per GDP. You want more GDP per debt. I think that's what it does, but it never eliminates the debt in my view. Um, all right. Well, we've hit a lot. Look, Tesla looks good. I'm just gonna say this real quick. I don't know when this thing's gonna blow, okay? But when it blows, it is gonna blow. The RSI looks really good. We're coming off the lows. We're starting to support that midpoint. Tesla needs rate cuts. If you remember back here, we had that big upside move. I thought we'd break out. We never did. We came back down. And I mean, this was lately, but a lot of the narrative here, the reason we couldn't break out is because we thought we were going to get rate cuts and we just didn't. Now we're getting rate cuts. Why is this important? Well, other, automakers are giving up on self-driving, on full self-driving. Well, they're giving up on EVs, right? They're not they're losing too much money. Bitcoin, Tesla is dominating the market. And not only that, but the big issue was that their margins were too high. I mean, I'm sorry, their margins suck. The margins dropped from 23% back in 2021 all the way down to like 15%. And now that you get rate cuts, that literally increases the margins on Teslas and demand, because now you can finance the Tesla for cheaper and you're getting tax credits. And if Trump wins, which, okay, that's another narrative. If Trump wins, this is very bullish for risk assets. It's bullish for crypto. It's bullish for Tesla. It's bullish for big tech in general. Maybe not all of them, to be honest with you, but it is bullish for Tesla and Bitcoin. All right, if you're a fan of those. So I would just, and China is about to implement full self-driving programs starting next year. Now we hear this all the time, but eventually things break out. If we go back to the past, remember Tesla consolidated for how many years? It peaked and it consolidated for about three years, peaked again, consolidated for 3 years, 2017 to 2019, didn't break out till, pretty much 2020. So 2.5 years. Well, we're going on 3.5 years, right? We're going on 3.5 years from Bitcoin. I mean, to keep saying Bitcoin because it moves like Bitcoin, consolidating pretty much. I think you could overlay Bitcoin and it looks similar. So once it breaks out, you're talking RSI like way out of the range, right? Tesla can stay overbought for a long time. So keep your eye on Tesla. Once you get above 265, you're looking at 300. Once you get above 300, you're looking at going to 400. And how do you play it? Who knows? I think it's a longer term hold, but it's been a while. And now Tesla's starting to look constructive again because we do have rate cuts, because financing is back, because interest rates are lower, because liquidity is coming back into the system. Maybe not tomorrow or next month, but it will be coming back into the system over the next 3 months. So my guess is this. Okay, the Fed is going to cut rates. Inflation is falling. The stock market still is unstable. You see the double, top here. Stock market remains unstable because who's going to get elected? Who's going to get elected is a question. How does the growth data look? Does the market just want to reset and price in the recession and then dip higher when it's not so, right? And this is literally what I think is going to happen. I mean, I'm not saying it will, but the probability is that the Fed cuts rates and the market still rolls over, because it's like, okay, you cut rates, but instead of moving up and selling off because there's a surprise, let's price in a recession. Let's price in the weakness. And then when we see the data show constructiveness, when we see the data actually show, the market rises, right? Now it's starting to rise off of strong data. Who knows what that looks like? But that's my guess, is the market doesn't even care about the rate cut immediately. It wants rate cuts. Don't get me wrong. If Powell doesn't cut, the market's going to tank, but it might be going lower no matter what. And it just wants rate cuts. I'm sorry. It just wants to see the damn data. Okay. It wants to see the damn data. Keep your eye on the VIX to make it clear. You want the VIX back below 20. It looks like we got below 20 today. And that could be, let's go to the daily. That could be because, the inflation data is actually looking really good. But if the VIX spikes, here's another thing about bonds. If the VIX spikes, it's going to be because of a growth scare. TLT goes up. If the VIX doesn't spike, TLT still goes up, right? So I still think TLT is a trade, and I'm going to leave you with that. Short-term pain, high, risk off trades, short-term pain. And then once we get into mid-October, that's when you should see Nvidia, AMD, Tesla, crypto, right? All those super, techie / growth names start to pick up again. That's all I got. for everybody today. I don't think there's no questions. I like SMCI, by the way. Tesla was going to go through peak during another example. Yes, I like SMCI. I am actually looking at SMCI to go long. I think it's way oversold. SMCI. I think a thing is way oversold at the moment. I didn't even like it. I warned you guys. Well, you guys probably different people, but they're like, should I go long SMCI? I was like, hell no. Look at this trend. Um, Once we came here and hit this, I was like, oh hell no, this thing's gonna dump. So I think it's time. I think it's time to start getting long, not fully in, but I think it's time to start nibbling into chips again, chip stocks. And I think just keep your eyes open for mid-October. That's probably where you see chips start to move up again, right? Mid-October. Nvidia, AMD, but definitely I would start nibbling here. They might have one more dip, maybe one more dip, maybe not. Maybe they just bid higher, but usually the cycle, the production cycle is starting to oversupply at this time, and then demand should be picking up again in October. So keep your eye out for the chips. SMCI, TSM, AMD. I like AMD. I think AMD still one of my favorite technical trades. Has been we're starting to get a nice little pattern here for AMD. So I really like AMD. It's taken forever to go long though. This thing's been downtrending for what, 6 months? March, April, May, June, July, August. Yeah, AMD's been getting crushed for a while. So we're getting around that time. AMD should be looking good soon. I would keep my eye on this. I like AMD better than Nvidia. Not maybe not. Options are good too because Nvidia's options are really juicy. The vol is really juicy. But AMD, Tesla, I think the things that get investors, degenerate investors, excited the most, I think that's coming back. SMCI, Nvidia, Bitcoin, Tesla, right? Those are coming back. I think it's going to take till October. We got the rate cuts. Until then, I think TLT goes higher. TSM shorts below 400. Oh, Celsius, be careful with Celsius, okay? I think it's going to bottom. I know we already went through this, but I think Celsius is near a bottom. You can see the bullish divergence. It's trying to pick up. It can't go much lower. There's no earnings, right? Earnings are over, so it kind of clears the way. But don't go all in. Nibble and wait for a bottom, and then boom, it should start to retrace. But I don't think it's going to retrace right away, like back to the highs. I think it's going to take 3 months to really see. I wouldn't even play Celsius by the technicals, right? Because demand is down a little bit. I would play it to the RSI. Once it gets overbought again up here, who knows where the price is going to be? Be careful and just start to nibble out, right? Start to nibble out, nibble in when you see this bullish divergence, and then nibble out once you get to the top right here. But this is going to take probably till January before it starts to pick up again. I'm not going to go through individuals right now. MU report. Oh yeah, MU. Let's see. MU reports. No way. MU reports already. Dang, this is a weird cycle. Maybe it's going to take Micron's report to really get things going. Okay, I didn't even see that. That's weird. They report so late. Okay. Micron might be a buy going into earnings, especially how bad it's beat down. So that's a good look right there, Vadim. Good looking, yeah, because we're getting crushed. So that should be a good buy. All right, I gotta go. I gotta get back to the I'm almost done with the course. Okay, I know nobody wants to get sold anything, but it is a macro course from beginning to end to give you more context on the markets. It should be ready October. I keep saying that, but I've been working on it. Should be ready October. We're talking how the financial system, the economic system work together, how asset prices, different asset prices move. You know, we talked about bonds. We talk about cyclical stocks, right? We talk about interest rate sensitive stocks, defensive stocks. They're all different. All the asset classes are like a salad. You have different ingredients and they all move when something different happens in the macro. So this course is about macro, and there's going to be mini courses, right? You have the big course, there's quizzes. There's going to be a written portion of it and video, very engaging. So you're not going to be bored. I guarantee you will not be bored for this course. Just stay tuned. And, you know, hopefully it's something that will work. But anyways, SMCI pumping their accounts. All right, I'm gonna catch you guys later. You guys stay blessed, lift weights, get smarter, eat something. I mean, eat healthy, take care of yourself so you can live long and make very good decisions for your trades, for your investing, for your relationships, for your health, whatever it is. Keep learning, stay smart, and stay blessed. I'll catch you guys next time. Thank you.